Let's talk about the AI spending craze today because I saw this headline and thought, no way in hell this could be true. Spending on AI data centers is greater than consumer spending. Why is that such a big risk, especially to people like you and I with jobs? And if spending on AI data centers is becoming the expectation or the norm, especially for these larger organizations, how much money are these AI software companies making? It's a complete house of cards, and I'm gonna get to that. But first, let's start from the beginning. Per usual, we need to build some context. So first things first, why is spending on AI data centers a bad thing? Well, I'll tell you right now, it's not a bad thing. In fact, investment from governments and businesses alike help bring that GDP number higher. So this increased AI spending is a good thing. You think with more spending would come more jobs. More jobs equals people with more money, and it creates this positive feedback loop in the economy, right? The more money people have, the more they're willing to spend, the better businesses do, the better stocks do, because their earnings are up. So it's not inherently that AI spending is bad, it's how much we've come to depend on the AI spending. We just saw in this headline that it's bigger than consumer spending. What does that mean? Why is it so important? And what could be the consequences of that? To start off, here's a list of countries of the world with consumption, consumer spending, as a percent of their GDP. You can see this number, if we sort from highest percent to lowest percent, most of the countries around the world sit around, let's say 50 to 70%. That's the overwhelming majority. And this has been the norm for some time now. And at first thought, that makes sense. Like, yeah, the people who live in a country are probably going to make up the majority of the spending in that country, plus some from the government, plus some from private investment companies, organizations. And when people have money, they like to live life, they like to spend money, they like to do cool things, they like to buy things that they enjoy, they go on cruises, they go on flights, they go to international destinations, whatever it is. Everybody likes to have a little bit of money to do things that they want to do, right? Well, I talked about jobs in more detail in a recent previous video, but in short, when this consumer spending slows, it's the opposite of that positive feedback loop. There becomes less of a demand for those products and services from businesses. Businesses need to then start cutting costs to save money. There goes Jimmy and Sally fired from their jobs. And when people don't have jobs, they don't have money to spend on products and services. And you can see how the cycle goes on and on. Well, how does AI spending play into this? You can see here that AI spending just officially became a larger contributor to GDP growth in the United States than consumer spending. Now again, not an inherently bad thing. If AI spending was up and consumer spending was up, this wouldn't be a problem. In fact, that would be a booming economy. The problem is that the headline number, the number that everybody sees, the number that everybody talks about, annualized GDP, looks really good. And everybody thinks at first glance, wow, that's great. This economy is awesome. You see Trump talk about how great the economy is doing all the time. And we can see it is, by the headline number, it is plus 3% on an annualized basis this past quarter, so April, May, and June. That's right in line with historical norm. We're on this slight decline, as you can see. It's probably averaging about 3% nowadays, so we're right around the average or the expectation. But this isn't because the consumer is doing really well. I thought, how in the world could this be right? That AI spending, private AI investment is now making up about 1 to 1.5% of the annualized GDP number. So then I thought maybe consumers are just, saving a little bit more money. The personal saving rate, or about how much money you or I save from our income, is about the same as it was in 2022. So something is going on beneath the hood, as we just hinted at. Well, here you go. Microsoft, Google, Amazon, and Meta are the main players investing at staggering levels, forecasting a record, just these four companies, forecasting a record $364 billion. Yes, that number's correct. $364 billion. The so-called Magnificent Seven, Mag 7, spent more than $100 billion on data center projects in just the past 3 months. When I'm trying to dissect something or learn a little bit more about the underlying dynamics of a situation, I like to visualize it. So let's visualize what this economy actually looks like right now. So you have these four mega cap tech giants, Microsoft, Google, Meta, Amazon. They're all in a frenzy buying chips from NVIDIA. as we just saw, a $350 billion investment in 2025 alone. So they're all scrambling to get these NVIDIA chips. Nobody can get enough of them. We're just going to keep buying. And that's great. So all these companies are making a lot of money. And NVIDIA, obviously, they're making a load of money. All right, that's great. So a lot of wealthy people, executives of these companies, big shareholders of these companies, they're making a lot of money. And just about every other company is scrambling to get Palantir AI services. Everybody needs them. I just made a video about this. It's insane how reliant we've become on data. Data is the currency of the world now. And so I deep dive about why every company wants this in that video here. But regardless, every other company wants Palantir, so they're making a ton of money. Now, on the surface, that seems great, right? The current state of the economy looks something like this. We understand now. All right, these big companies buy chips from NVIDIA. They also buy services from Palantir. Palantir buys services from them. Okay, so we can see we kind of have this big circle. Let's just call it the big tech circle. This is the current cycle, the AI cycle of spending. And all the other companies chime in here. Okay, what's missing here? Well, people, the consumers, human beings are missing from here. We use various services from these different companies, but we're going to get there. 1 second here. Let's go through quickly what a happy cycle looks like. A happy consumer cycle. So you and I are jolly. We're making money, we're spending money. What does the jolly cycle look like? Well, we talked about it already. So let's say companies do well up here. This is companies. They hire people. So they hire people like you and I. When they hire people, we make more money. People make money. When we have money, we do cool things. So let's say partying over here. Yeah, party. And when we party, we buy from these companies. It's a great cycle. Everybody's happy. The companies are happy. Shareholders of the companies are happy. Because companies are happy, they're going to hire more. People are going to make more money. They're going to party. They're going to have a good time. They're going to enjoy themselves. And they're going to buy from these companies. It's a great cycle. Happy, happy, happy all around. Well, that's not what's happening today. The consumer isn't very happy. Jobs, as we talked about in great detail in this prior video, are not looking great. They have some underlying dynamics, just like we're diving into now, that don't look very attractive, but on the surface are looking okay. And so clearly these companies, let's just call them the Mag 5, right? Like we just talked about, Microsoft, Meta, NVIDIA, Amazon, and Google. Amazon has some more consumer impact than the rest of these do. So we'll just leave them out for now. But you can clearly see that, yeah, no, these companies have been doing pretty good and have been carrying the S&P 500 for the past 5 years, the past 1 year, the past all years. Yeah, you get the point. And that's clearly apparent because now the S&P 500 is, you guessed it, made up of basically only these companies. The Mag 7 right here, so those companies we just talked about, make up a staggering 35% of the entire market cap of the S&P 500. Again, that's not inherently a bad thing, but think about it. If all of these companies are worth so much, it is kind of a systematic risk to the economy. If, you know, the AI spending craze dies down. And why would the AI spending craze die down, right? It seems like it's infinite at this rate. Well, the kicker out of all of this is that AI companies, specifically AI software companies, aren't making money. That's a problem, right? We have billions and billions of dollars flowing into these AI companies, OpenAI we're going to look at here shortly, yet they have nothing to show for it. They're losing money with every single user that signs up. You can see here, OpenAI lost $5 billion in 2024. Losses are increasing. We're still not sure how OpenAI's paying subscribers, the ones that are actually paying for those ChatGPT subscriptions, how sticky those customers actually are, meaning are they going to stay and continue paying, or was this kind of like an initial surge? How long are they going to stick and continue using the service? And as we mentioned, OpenAI loses money on every single paying customer, including free users, obviously. And you know what? That's not a problem because OpenAI continues to spend. In fact, they're valued at $500 billion right now. And you and I, cannot invest in them. That's only for private investment. This is the definition of a house of cards, right? More or less a Ponzi. You have this company, OpenAI, which is doing fantastic things. The technology with ChatGPT and these image and video generation models, most people agree this is a big step in the right direction, saves a lot of time for people, makes Google searches just inherently better on a daily basis. You can pretty much ask it for life advice nowadays. But again, this is a systemic risk to the stock market, to the tech industry, obviously in particular, because all these companies are throwing billions and billions of dollars of capital investment hand over fist at OpenAI is one example in particular, but these software AI companies that don't make money. Like, yeah, it looks great because we can invest all this money, and like we saw in the GDP numbers, it looks good at the headline. The United States is growing at a 3% rate annually, but underneath the hood, that's just all these companies being absolutely obsessed in smoking the AI drug. Without this spending, the consumer and the economy would be looking a little more dire. And if the economy was looking a little more dire, the stock market would probably be not as frothy as it is today. And businesses would be much more worried, be more hesitant to hire, and we're already seeing signs of that as we talked about. Let's finish up this OpenAI conversation. With a house of cards, you take out any one of these pieces here, any one of these cards, well, the whole thing falls. And what's holding up OpenAI right now? Well, as they continue to increase their losses, increase their burn rate, how do they pay their bills? They rely on private investment. And when private investment goes away, well, this whole deck of cards, or house of cards, I should say, will come tumbling down. So for the time being, as long as companies are foaming at the mouth and shitting out cash to throw at this profitless AI company, not just profitless, burning billions of dollars, then the house of cards will stay standing. But as OpenAI continues to raise this valuation, $500 billion at this point, eventually I think some people are going to start thinking, okay, wait, they're not making any money and they're worth $500 billion. They're growing at a crazy rate. So right now it may be justified, but at some point, reality hits, right? Like, the money can only flow into this company for only God knows how much longer. And who knows, maybe this is the never-ending Ponzi, right? The never-ending house of cards. As long as we keep increasing debt to grow these companies and artificially raise the value of everything, maybe the economy continues to thrive and the consumer survives through it. I don't know. I guess we'll see. But it does feel eerily similar to the .com era in a way, because I don't know if you remember this back in 2020, 2021, AI companies, especially I remember this one, C3.ai, ticker AI, was pretty much bought because people just wanted exposure to AI, and this one had the ticker AI. So, you thought you were getting exposure to an AI ETF potentially, or solid AI companies. Most AI software companies at this point are not doing the best because they don't make any money. Palantir and Tesla are pretty much the only large companies that have figured out how to make money and monetize AI. To finish up, I know this has been more of a negative discussion and kind of just on large companies and how much money we're throwing at profitless AI software companies. But at the end of the day, like I mentioned, these products are still fantastic. You can pretty much ask ChatGPT anything that you want and you'll get yourself a pretty solid answer. But at some point, and we're already seeing that point, we will come to a curbing of the development and improvement of these AI models. At the beginning, your money goes a long way. For example, they use the phrase PhD level intelligence. Let's say when the first large language models came out, they were at a toddler or middle school level intelligence. Well, getting from middle school to high school to college was not as difficult. The money, the billions of dollars that you're throwing into these LLMs goes a long way. But as you start improving these models to go from undergraduate to graduate to PhD level intelligence, you got to start throwing exponentially more money to get exponentially less results. So again, are we in a bubble? I mean, the signs are there. The .com era was very similar. It was just everybody buying .com and investing in internet companies that didn't know how to make money. Today, companies are throwing billions of dollars at these AI software companies that don't know how to make money. And like we said, there's a few big players in the space, namely the mega caps and Palantir, that have figured out how to pretty much make this an infinite money glitch and print money for their executives, for their shareholders, for their business. I think at the end of the day, for the consumer, this is you and I right here, it really comes down to if you don't have exposure to these assets, to these companies, then you're gonna just keep falling further and further behind. The trend doesn't seem to be stopping. It seems to only be accelerating. Is it inherently risky to get exposure at these frothy levels, these frothy valuations? Yes, but I'm afraid there's really not much of an option, especially with interest rates set to come down over the coming years. High yield saving account rates are going to come down. So your real only option is to invest in the companies that are making money. And those are the companies, well, that, we just talked about, Megacap and Palantir. So I want to hear your guys' thoughts. Do you agree this is reminiscent of a house of cards, as I like to put it at least? How funny is it that the typical retail investor still can't invest into OpenAI at now a $500 billion valuation, even though consumers are the ones using their product, ChatGPT? Leave a comment, let me know what you think, because again, everything seems to be just fine, just merry and jolly on the surface, but clearly when you open up that hood, it becomes a little more nasty. So I wish the best for all of you. I hope that you're all able to accumulate wealth and get exposure to these opportunities while you can. All right, that's it for me. I'll see you guys in the next one. Peace.